I will start to just highlight what SKAGEN M2 is for new friends in the audience maybe. SKAGEN M2 is a global real estate fund investing in listed real estate in all sub-segments. We have existed for 8 years, and we have in Norwegian kroner a performance of about 10.7% annually net of fees, and we have a daily liquidity. So this was short over the fund, and moving over to the presentation. Some of you are familiar with this agenda, but there are some new things I want to highlight as well, and some updates. First of all, as you know, this has been a challenging year for all of us operating in the market, especially for me operating in the real estate market. We have had one of the worst performance of the different sectors out there, but we're catching up now. And just to give you an example, global all sector index are up about 12% in Norwegian kroner, and the global listed real estate index is down 10%. So it's actually a difference there between the two of 22%. So where are we now, and what is happening? And what will happen next year? Well, that's a good question, but as you know, it will be decided of the continuous recession or the potential recovery, right? And the values of the real estate or the assets will be decided by either the depth of the recession or the pace of the recovery. And this is important. We had a vaccine news a couple of weeks ago, and it turned everything upside down a little bit. But what it mainly did was to remove some uncertainty, or give some sort of limit from or remove uncertainty that we like in the financial markets. So what will happen from now up till the vaccine is distributed, we know that it works, and so forth, will be a little bit more bumpy road, I think. We have stimulus packages in work, huge packages from US and Europe already launched. There is likelihood that there will be further packages coming along, and this will obviously drive the economic recovery, hopefully. But when and how long this will and how steep it will be, nobody knows actually. And again, real estate is like a late cyclical industry, so there will be some catching up here to do, but everything depends on the pace of the recovery, I would say. But we have some catching up to do before that, due to the losses that we had already this year. I will come back to that. We have seen the rotation starting with the vaccine use, and the rotation in real estate industry is not similar 100% to the all sector, because in my industry we have companies with that were in big troubles already before the pandemic in some certain sub-segments, and they went into deeper troubles during the pandemic, some mall companies, for instance. So everything that is cheap now is not a good trade, that's for sure. It's typically many companies out there still that are cheap for a reason, so one has to beware. But there are some really interesting sectors, subsectors and cases out there. What I believe in 2021, first of all, then the economic recovery is leading the way here. And we have the policymakers and the governments and central banks doing everything they can to avoid a credit crisis that they have been through before. And this is not a credit crisis depending on the real estate as last time. Real estates are typically in many segments very well capitalized and had a very good demand pre-pandemic, and some of them still have an increasing demand. So, but things have changed a little bit during the pandemic here. We are not certain how everything will play out in terms of disruption. How about working from home? How about traveling? How about going to shopping malls, etc., etc. So things might or will change, and it will have effect on my sub-segment. I think 2021 will bring a prospect to small and mid cap, because they are not the low-hanging fruit that has been picked now in many cases, or are picked as we speak. I think emerging market will be some good cases that could be found. They have been rolling out of the pandemic faster, and we'll see faster growth. I think we will see further takeouts from the stock market, especially in the office side. We had one in the portfolio this week. I will come back to that. And I think as well I can come back to that. Let's start with this familiar picture that you have seen before. On the left side, you have the start of the pandemic on the financials, on the stock market in the US. This is US listed real estate. It's the biggest market and has the most categorized subsectors. The ones of you that have seen this before see now that the bars are not that long down or as so much south, so to say. If you remember, in March, April, they were about, some of them were about below 70 almost. And you have on the right side, you have the recovery. It's the 23rd of March. We have seen some sub-segments recovered very well. And this is in many cases mirrored in the European market or other markets for that sake. But I would, in this context with sub-segments, it's a little bit more visible. So this is the same picture, but the blue bars are how companies were actually valued in relation to net asset value in the beginning of the year, pre-pandemic, and the green bars are post-pandemic. So the ones that have a green bar below the blue bar are the ones that we are looking for bargains, or the ones that you still can find some good value or mispricing. And the blue bars have actually become, in some cases, more expensive than they were pre-COVID. We're talking about this COVID safe names in data center, in logistics, towers, etc. So should we go buy everything here? Yes, you could do that, but one has to be aware of the risk here, I think. We find, and have done so, I will come back to some example, found good cases within office. I think also hospitality is not over with yet, even though I think they will have, as the shopping malls and some other segments, they will have some really bad quarters coming through here. But as they say now, market will look through that. I'm not totally convinced that market will look through that, because in lodging, for instance, things will typically normalize in 2022, and it's 1 year to 2022, and a lot of things can happen. But there are still values and there are still good opportunities out there. I often get the question, shopping malls, they are dirt cheap now. Why don't you put all your money in that sector? Well, one can find really good opportunities. We have seen that in Europe, and we have seen that in the US as well. But I took this the other day from Bloomberg. It's the worst and the best in the mall segment. If we look from the bottom, we have CBL, Penn Real Estate, etc. These are names that has filed for Chapter 11. Basically, they are broke. They were really on the line before the pandemic, and the pandemic broke them basically. And you have the same pattern in many of these names. They have full debt already, and they have no income when you had this lockdown. On the top end, you have Taubman, for instance, and Taubman is under a bid situation from Simon Property Group. So it's a lot of bid premium in that performance as well. So you can do good deals here, but one has to be very certain of what you're doing. We have some similar names in Europe as well. Unibail is one of those, and they are trying to recapitalize now. They're changing management and so forth. And you have a lot of short covering in these names. One should be aware of that. SKAGEN M2 is not about maximizing the profit or return to every price. I've said that before. SKAGEN M2 is about long-term performance with balanced risk and return perspective. So I'm avoiding many of these names, right or wrong, because I think it's too much risk in many cases. But I participate in this sector through my conglomerates, for instance. I think also one should have the long-term perspective here. This is goes back to millennial, 20 years. This is US stock market again. Very broad sector allocations from the benchmark. 20 years ago, retail was about 35 to 36% of total market cap in the US. That has come down now to 6, 7. Will probably come up a couple of percent on this value trade that we see now. But still, it's declining and it's very low compared to 20 years. This is the typically secular shifts that we are referring to or have been doing before many times. This on behalf of other new rising sectors like the new economy, real estate, towers, data center, logistics, student housing, many healthcare assets or subsegments, etc., self-storage. I think it's wise to have this perspective while talking about value trades, because that's the only thing that you read about now since the vaccine came. There are a lot of opportunities, but one should be aware of that, the risks. Now over to the fund. Now it's Euro B, it's Euro B share class, has only existed for about 5 years, but the fund has existed for 8 years. We have an accumulated performance in Europe of about 30%, and the benchmark is 4%. Taking it per year, this is Euro class A, so we got the inception as well. We have a yearly performance of about 6 or 5.8% in the fund, net of all fees. This year we're struggling a little bit, and I will come back to why that is. Let me first go into the activities we have done recently or the last couple of months. We have increased the positions, as I said, in 4 office names. One is an old friend, is Columbia Property Trust, that we sold out early in the pandemic, but now bought back on very good levels. We have taken out some office names as well. SL Green, for instance, is the New York-based name. I thought things were a little bit too nasty in the pandemic in New York, so I actually chickened out in that case and sold off. Company has also a bit more stretched balance sheet, and I think that is important going forward to have a balance sheet that provides you opportunities, and also in this environment. I sold that equity residential, unfortunately too early, and I did that because they guided the next coming quarter as much worse than we have seen already. So I took the safe bet there. And I scaled down Equinix data center, one of the largest real estate companies in the world, taking it down to about 3% now. We have seen the value trades hurting stocks like this. Many sector funds are going over to value. Equinix is one of their components in the benchmark, so taking that down. It's still a very interesting company, but I come back when things have calmed down a little bit. Scale down, taking profit from Catena. Log is also logistics, and Deutsche Wohnen. Since I have exposure in Germany already, and I wanted to take some profit to use in the new names. Well, while we're talking about value, this is maybe a little bit misperceived in the portfolio. This is not a growth portfolio, and I know it's probably my own fault. I have been talking about data center, logistics, etc. for many years, because I find it quite interesting and as a new evolving segment in the real estate world. But on the left side, you have the COVID losers, or some part of them anyway, that have been COVID losers. It's office, it's modular housing, it's pubs in CK Asset Holding, And you have a lot of these names. Many of them are smaller mid-cap that haven't actually get paid off yet, because it has been the larger companies that have been traded up last couple of weeks. So I'm very confident that they will follow suit within some time. We have Arima, for instance, Adapteo haven't followed either, and many of these names. Entra we have, and luckily, that was very good news this week, a Swedish company called Samhällsbyggnadsbolaget tried to bid for Entra, but the board rejected it almost instantly. And this morning, another competitor, also Swedish, Castellum, bid for the company. So that has been a very good journey. And that is also one thing with 2021. I think we will see more of these either takeouts or industrial players want to merge. I'm almost sure of that because of the low valuations that we see in some companies and some sub-segments. Also, that will happen for sure in the malling industry, but also in the hospitality industry. So that's about 50% on that side. The other side, you know already very well, it's the steady earners, if you like to call them that, or the growth names. That is data center, self-storage, regulated markets, rental residential, Germany, Sweden, for instance. US, it's unregulated, so it has actually been quite hurtful to be in that segment in US. And some healthcare names with long leasing contracts. This is to obtain the balance, and that's what we should continue to do. But the new names that we are investing in are mostly on the left side, and that is the rest of the 50%. And this is the barbell approach, like it's a name everybody uses in the finance industry nowadays, just to keep the balance. And I think it's a good way to keep the risk-adjusted return on a long-term good level. What has worked, what has not worked the last quarter, and this is interesting. On the left side, you see CA Immo, it's office in Europe. You have Mitsui Fudosan, it's mainly office, but also apartments in Japan. Around town, it's hotels and office in Germany, Netherlands, and some other places. These are the value trade names that start to perform now, that has been a drag in the portfolio over the year. Still have a data center office operator Kei Hanshin, and due to the bid that came a couple of weeks ago. And we also have Log, which is the Brazilian logistic name that places itself on the right side, basically in the barbell approach. The bottom five is all on the right side now, the last quarter. It's Shurgard, it's Arima, which is one of these names I referred to, small cap Spanish office name, full capitalized, 100% rent collection, but they are small and they are not the low-hanging fruit that generalists are picking up in the first place, but they will come as well. Self-storage group, self-storage again, has been very successful this year. Equinix data center and Koyama rental apartment. Over the year, on the left side, you have all these right side names still as the big winners. And on the right side, we have office, apartments, some logistics. I regret that I sold some of them, but at that time in the spring, when the pandemic hit Europe the most, because many of those I sold in the spring, things had not started to get as nasty in US as in Europe in terms of pandemic. So I actually took them down to be better to be safe than sorry, and I hadn't the time to hit the recovery. So we lost a little bit on the recovery part there. There is one reason to the underperformance. The other reason is that the value trade now, the last couple of weeks, has been very heavy, since you have about 15% of retail names still in the global benchmark now. And since we're not there in that big weighting, that has been hurtful. But also that we haven't seen the recovery or rebound from small and mid cap. With that said, we have done a lot of good things as well, as you can see on the left side there. And we try to continue to do that. This looks a little bit the same, the sub-segment allocation. Office seems like it doesn't have moved, but it's actually that we have sold out some office to replace it with other. And also industrial logistics has come down a little bit since this was done. So it's no very big news there. I would say office will continue to increase a little bit. Country allocation, same thing. We have sold down, for instance, Equinix heavily, which means that US looks basically the same, but we have replaced it with other US name, and it's also on its way up. Otherwise, it's basically the same as many of you have seen at the last update. There's no very big movements here. Concentrated portfolio, I said before, Equinix has come down since this picture, and there has been some smaller movement as well. And I'm pretty sure that you will see some of the value trades or the left side of the barbell approach climbing up this year and also beginning of the next year. The passive side of the portfolio, the debt side, the credit side, is also aligned with what you have seen before. The loan to value is 39%, very comfortable. Also the net gearing, since this is a very capital intensive industry. We continue to look after strong capitalized companies, especially now in this time where you know there will be continuously some heavy quarter coming in for some of the companies. But the portfolio is still lower leverage than the benchmark. We have better earnings yield and we have a more attractive valuation. So this is still a fund that you can find good value in. The only thing we're missing out versus the benchmark is the dividend yield, which benchmark is higher. And this has its rational explanation in that we prefer companies that have a growth component or a growth engine within them, refurbishment, repositioning, new build, etc. But it should also be standing assets on top of that to provide some stability. So instead of handing out all the money, you recycle them into the company if you have good projects to invest in. So over to the case. We have 5 new holdings. Oops, like that. 1 in Canada, 1 in Japan, 1 in Belgium, 1 in US. This is New York, but it's not only New York, and logistics. So first of all, I would just go through the segment office that I have been referring to. Why is that? Because it's a lot of question marks out there about office now. And some of the question marks has arrived as a consequence of COVID when people started to work home. Will we ever go back to the office? Will office exist down the road? Is this the new retail? I claim it's not, and I think there are value to be found in office, but it's not a straight line. We have also seen all the underlines there. We have also seen a lot of huge players and much capital searching for real estate and searching for office. We have seen private equity going into London, Great Portland. We have seen Brookfield taking a stake in British Land. We now see Castellum trying to buy Entra, etc., etc. So obviously there are money on the sideline that want to go into this sector. A reminder: this is the US office space, the white line. The orange line is the all REITs, all real estate listed, and the blue line is S&P 500. So you see a clear lagging. And why is this? Well, one of the question marks is this: is the office the next retail, disrupted by working from home? Either you can think about it like, are we where we were in the bottom at the grand financial crisis? Basically a very good occasion to buy office, or are we where retail have been the last couple of years, or especially the last year? I would say we are more in the first than the second. I think it's a good opportunity to buy office. The reason is you will have disruptive elements from working from home. everybody's more or less agreeing upon that, but it will not kill the office. What is more important is the cyclical movements, because this is late cyclical business and it has a great correlation to economic development, as you all know, especially office, I would say. So that is why this is not a straight line. But remember, we came into the pandemic with record low, just to look at Europe, for instance, record low vacancies, record high rents, and very good demand. So, and the companies are very well capitalized compared to the last time. Probably there will be, if the economic development not turning very quickly, there will be some downward leaning rental development, especially in some cities. There will also probably be some value that are declining due to the lower rents, maybe a little bit higher vacancy. That is a bit compensated by some of the office names. We have some in our portfolio that have long-term rents that haven't been renegotiated in a long term. So they have a big upside to market rent. So even if the market rents come down a bit, they still have a good upside on the lying rent, so to say. It's a good rent roll. We also have, over the long term, you have an urbanization trend, and that will probably continue. I'm of that conviction anyway. And I mention this because we have also a discussion now that people are moving out from the big cities and they will live in rural areas. There are elements of that, and I think most of the elements of that is also a consequence of the corona pandemic. I think there will be people moving back to the cities, and I think the attraction of the cities is very high still. So beware of the cyclical effects here, but the page I showed you before with the difference between when we entered the year and where we are today, it's a huge difference in term for the office side. And I would say pricing today has taken account in a more negative cycle for office. So there are still a lot of value to be found there. This is a working from home. This is a summary, one can say, from very many studies that have been made. On the right side is the last one I've seen. Will your company work from home? How many of the employees, etc. So you actually have put on the demand side and the negative demand side, and they have boiled it down in this, gathering a lot of surveys done in the European Union. We will have a demand shortfall of about 48%. So, and if I read globally, it's about 5 to 10%, but it's also depending on when this survey is done. Is it done in the spring? It's 10%. Is it done now? It's more 5%. So yes, there will be some shortfall from this as well, but it will not be the new retail. Also the rent collection, this is second quarter, Japanese office, US office, and European office average. Still good rental collection and cash collection. We have seen that in the Q2 report as well, that has that's actually ongoing still. So I'm very comfortable there. Well, over to the case, short, Allied Properties, Canadian REIT. Mainly office player, but they also have 3 data centers. They are present in 7 Canadian cities, mainly Montreal and Toronto. And Toronto is interesting because they have had very strong growth for tech employees, actually stronger growth than San Francisco. So many young people, many young tech talents wants to go to Toronto. The company has an embedded growth profile with a pipeline of 10 million gross lease area, of which 1.6 million is under production. They also have 4 million gross lease area zoned for production, but it has not commenced yet. And they have 3.4 million gross lease area outside of the books, which is not zoned, so it hasn't entered the books yet. So it's actually a hidden value. We are buying this company at 25% discount to last reported NAV, and it's in line with the financial crisis. The thing is that this company is much better today than at the financial crisis. Also very much more capitalized. They have an investment grade rating Baa2, net gearing of 41%, dividend yield of 4.6, and a cash flow yield of 11%. So this is an interesting company in the segment I just referred to, but they're well capitalized and well positioned to take further steps in the future. Columbia Property Trust, the next company name. Some of you remember that it was in the portfolio. They are present in the gateway cities, San Francisco, New York, Washington, and Boston. They have also a pipeline with projects, which is the growth engine. Has a very strong balance sheet, is trading at 0.6 times book, dividend yield of about 6%, and some interesting triggers with potential share buybacks and of course the recovery of the office segment. Next case is Japanese, also a office name. It's a small cap, it's 1 billion euros market cap, and it's Heiva Real Estate. They have basically three legs they stand on. One is the development of office, maturing them and sell them to a REIT, which they own about 15% or 14% of. So they recycle capital when selling what they have done. They have also a leasing leg with a standing asset that they own, and they have also this redevelopment leg where they're actually revitalizing, especially the finance district in Tokyo. They own the building where you have this Tokyo Stock Exchange and also the Osaka Stock Exchange. So it's an interesting area in Tokyo that is up and coming. Other things that are really interesting with Heiva, I think, is that they are trading at about a little bit above 1.1, 1.2 times book, but they have a lot of hidden assets in unrealized gains in the portfolio. So they are actually trading at about 0.6 times net asset value. So 0.6 times net asset value. So it's a lot of value in that balance sheet. Another thing that is interesting with this company is that it has been for a long time majority owned, about a little bit above 10% by Mitsubishi Estate, which is one of the larger real estate companies in Japan and in the world actually, but they have only owned it, and it has been like a wet blanket over the company. The company has also a poison pill written in the statutes, so they're actually impossible to take this company over or acquire this company, which many of the other competitors would like to do because they like this land plot they have in Tokyo, this financial district, and the development they have ongoing there. But in September, Simplex Asset Management entered the stage, took a larger position than Mitsubishi Estate, and there are a lot of international investors in this company now that wants to remove this poison pill at the AGM, and it has been very close the last couple of years. So this year, I think it will happen, and they could then crystallize the value of the assets, but also improve the governance. So interesting case. Fourth case, you're probably familiar with this, and you asked me, how come you invest in this company? It's trading at 1.6 times book. Yes, but it was trading at 2.3 times book before COVID. The interesting thing about Aedifica is that they are doing senior care mostly, but they're also into childcare and other segment within the healthcare. This is a consolidator in Europe, and they have a successful story of consolidation and growing. And this is a segment in Europe that needs consolidation. They have today 100% occupancy. They have about 20 years average lease length, which is security. So this company would be on the right side of my barbell approach, the stability, but with growth. You have 780 million of internal pipeline, organic growth already, in 6 different countries where they operate. And the long-term driver here is obviously aging population in Europe. There are 25 million 80 plus people today in Europe, or people over 80 years. And in 30 years or 2050, there will be 130% more. So more than double. So this is a long-term growing company that grows into the trend channel that we see with aging population. They also acquired a Finnish company doing modular housing, so they rent out modular housing to childcare and aged care, and that name was Hoivilatat. So it's an interesting growth story there. Well, I'm a little bit over my time as usual. I open up for questions, and thank you for taking the time to listen to me again.